Okay, let's unpack this. When you think of Amazon today, I mean, your mind probably goes way beyond just that online store, right, where you order, well, pretty much everything.
Right.
It's this huge, sprawling empire. It's deep into cloud computing.
Yeah.
It's pushing boundaries in AI. It's a major force in entertainment, devices. I mean, the scale is just vast. And somehow it's all guided by this idea they call day one. It's really quite a contrast to how it started, just as an online bookstore.
A massive contrast.
So that's really our mission for this deep dive. We're going to dig into Amazon.com Inc., that's AMZN, using this recent financial analysis framework you shared, dated June 2nd, 2025.
Yep, got it right here.
Our goal is basically to pull out the most important bits of knowledge, try to cut through all that complexity, and give you a really clear picture of its core businesses, its market position, the financials, the risks it's up against, and its strategy going forward, all based strictly on this analysis.
Exactly. Sticking to the source material.
Yeah. And why is understanding Amazon so crucial for you right now?
Well, because it's more than just one company, isn't it? It's this dominant force shaping huge parts of the global economy and, frankly, our daily lives.
No doubt about it.
It impacts how we shop, how businesses run their tech on the cloud, how AI is getting rolled out, even how we watch movies or use smart speakers at home. So, grasping the engine driving it, the challenges, the future plans, that's pretty key to being informed today.
And what's fascinating looking at these sources is just how diversified Amazon is now, but they always seem to tie it back to that customer focus. The analysis lays out the core segments really clearly. You've got Amazon stores,
Which is the huge e-commerce side, including that marketplace, what is it, over 1.7 million smaller businesses?
That's the number cited, yeah. Small and medium businesses selling right there on the platform.
And that's just one piece. Then there's AWS Amazon Web Services, which the sources say isn't just a player. It's the global leader in cloud, offering, 240 plus services?
Yeah, over 240 distinct services, powering everything from startups to massive corporations, even government agencies. It's foundational infrastructure for a lot of the internet.
And AI. It's not like some separate lab somewhere, is it? The analysis suggests it's woven into almost everything they do.
That's exactly how it's described, integrated everywhere, from, the recommendations you see on the store, features and Kindles, but also, crucially, as services offered through AWS to over 100,000 business customers. It's a layer across the whole company.
Plus that whole entertainment arm, Prime Video, Audible, music, Twitch, games, and the devices segment too. Echo, Alexa, Fire Stuff. It really is an ecosystem.
It is. And like you said, the analysis hammers home that core mission, Earth's most customer-centric company, backed up by those 4 principles: customer obsession, passion for invention, operational excellence, and thinking long-term.
And that day one culture.
Yeah.
Trying to keep that startup energy.
Right, exactly. As they define it, it's about maintaining that initial agility and, entrepreneurial spirit, as if they're always just starting out.
But it's interesting. The sources mentioned they describe themselves as a set of startups, which sounds great for innovation, but at Amazon size. Does the analysis talk about the challenges of keeping all those startups working together or managed efficiently?
That's a really important point. The analysis suggests that, while that model fuels innovation at their scale, it really needs strong central leadership and really smart capital allocation, making sure all these different parts are actually working together, not, stepping on each other's toes and adding value to the whole picture. It's a built-in tension.
So how do they decide which inventions to chase after?
The sources are super clear on this. It's driven by that working backward from customer needs method. It's not just a process. It's like baked into the culture.
Right.
Start with the customer need, even if the customer hasn't quite figured it out yet. That's how they apparently came up with things like Prime or Alexa. And this approach, it builds incredible loyalty, and it creates stuff that's genuinely tough for competitors to predict or just copy. Really reinforces their moat.
And thinking about structure, they've got dual headquarters now, Seattle and Arlington, Virginia. The analysis notes Arlington wasn't just random growth, it was strategic, wasn't it?
Yeah, strategic, closer to the U.S. government, tapping into a different talent pool, logistics advantages. It definitely signals, their increasing interaction with the whole regulatory and government side of things.
Makes sense.
Absolutely. And of course, being public on NASDAQ QAMZN gives them access to huge amounts of capital for investors globally, which is essential, really, for funding those massive long-term bets they make, like AWS infrastructure, AI research, or even Project Kuiper, their satellite internet thing. It directly fuels that passion for invention and long-term thinking.
Okay, so let's talk markets. The numbers in this source material, They're just staggering.
They really show the scale of ambition here. Okay, first, global e-commerce, projected at $6.33 trillion for 2024, expected to hit over $8 trillion by 2027. That's about 8.3% compound annual growth. Solid.
And that's not even counting B2B e-commerce, which is growing even faster.
Way faster. Estimated $19.34 trillion in 2024, forecast to jump to nearly $47.54 trillion by 2030. That's over a 16% CAGR. Huge potential there.
Okay, retail's massive. What about cloud computing? AWS's turf.
Also massive and fast-growing. Estimated $752 billion market in 2024, projected to almost triple, reaching $2.39 trillion by 2030. That's a powerful 20.4% CAGR. And AWS, according to the analysis, holds a major 31% share of that booming market.
Wow. And digital advertising, they're pushing hard there too.
They are. Over $790 billion globally in 2024, projected to hit, get this, $1.77 trillion by 2033. Amazon's specific strength is in retail media networks ads on their own site. That alone was over $22 billion for them in 2024, per the analysis.
And don't forget digital media, online entertainment, Prime Video, music.
Right. That whole market was over $874 billion back in 2023, growing around 13% annually. You specific online entertainment part, about $100 billion in 2024, also growing near 13%.
So across the board, we're talking huge markets with really strong growth trends.
That's the key takeaway from the analysis. Amazon is riding these powerful secular tailwinds, just massive demand growth for e-commerce, cloud, digital ads, digital media.
But it's not just being in these markets, is it? It's how they link them together.
Yeah.
The sources stress this synergistic potential. How does that actually work?
Well, it's kind of like a flywheel or self-reinforcing cycle. The data they get from all that e-commerce activity, that feeds their advertising business, makes it smarter, and improves their AI algorithms.
Okay.
Then you have Prime, which bundles the retail perks with entertainment, making customers super sticky. They use multiple services. And critically, AWS isn't just for outsiders. It's the tech backbone for all of Amazon's own stuff. Retail, ads, Prime Video, you name it.
So more shopping means better ads and AI, which maybe makes the shopping experience better, which leads to more shopping. That kind of loop.
That's exactly the dynamic the analysis describes. A truly integrated ecosystem where the whole is way bigger than the sum of the parts. Logistics supports AWS data centers. Retail data informs AI used in AWS. AI from AWS makes retail ops and ad targeting better. It all connects.
But of course, that kind of integration and scale, it attracts eyeballs, both competitors and regulators, right?
Absolutely. It's a double-edged sword. They have to navigate that complexity.
So let's talk competition. The sources name the top 3 key competitors based on scale and where they overlap. Microsoft, Alphabet, and Walmart.
Yep, those are the big 3 identified.
Okay, so Microsoft, primarily Azure versus AWS in the cloud war, right? But also gaming, some ads, hardware.
That's right. Azure is the main battleground with Microsoft. Then Alphabet, you've got Google Cloud Platform, or GCP, also competing with AWS. And Google Ads is obviously a massive competitor to Amazon advertising, plus subscription stuff like YouTube versus Prime Video and smart home devices.
And Walmart. That's the head-to-head on e-commerce, but also the huge physical retail presence. The analysis is said Walmart's investing heavily online, using stores for pickup and delivery, building its own ad network.
Exactly. Walmart's leveraging that physical footprint for omni-channel, and their retail media network is growing fast too. And looking at the financials table in the analysis, these aren't small companies. Amazon, Microsoft, Alphabet, Walmart, they're all global giants. Hundreds of billions in revenue, market caps in the trillions or near trillions. Huge resources.
The analysis kind of frames the competition now as a battle of integrated ecosystems. Everyone's using their unique strengths, right? Microsoft's enterprise links, Google search data, Walmart stores.
Precisely. And AI is called out as a critical new battleground. All these players are pouring unbelievable amounts of money into AI research, talent, infrastructure like data centers, specialized chips. It requires massive capital spending from everyone involved. Leadership in AI could be a game changer.
So with that level of competition, how does Amazon defend itself? What's its competitive moat, according to the analysis?
Well, the sources stress it's not just one thing. It's a powerful combination of advantages working together. First, you got brand recognition and reputation. People associate Amazon with convenience, selection, price, service. That's incredibly valuable globally.
Then there are network effects. More buyers attract more sellers on the marketplace, which means more selection, attracting more buyers.
Yeah.
And the Prime ecosystem locks people in across services.
Definitely. And the logistics and distribution network is absolutely key. The analysis calls it vast, advanced, and just incredibly costly and complex for anyone else to build from scratch.
And they're still investing heavily there, like that $4 billion plus for rural delivery announced in April 2025, adding tons of jobs and locations.
Exactly. That move deepens their vertical integration, taking control of more steps, especially that crucial last-mile delivery. The analysis even contrasts this with news from traditional carriers like UPS, highlighting Amazon's strategic push for self-reliance. It strengthens that logistics moat significantly.
Okay, what else? Technology and innovation are obvious. AWS leadership, AI R&D, that why Crutcher's pushing development.
Right. And customer obsession, that working backward thing, isn't just talk. It drives strategy and builds loyalty. And finally, economies of scale in purchasing, logistics, tech. It lets them operate efficiently and price competitively.
But the real strength, the analysis says, is how these things connect and reinforce each other. The synergy.
That's the key point highlighted, the synergistic interplay. Logistics helps AWS. Retail data fuels AI and ads. AI improves retail and cloud. The total value is way more than just adding up the pieces.
Okay, but what about challenges to this moat? The sources mentioned growing regulatory scrutiny, right? Targeting marketplace stuff, data use.
Yeah, that's a major one. Scrutiny on potentially favoring their own products, maybe requiring sellers use FBA, how they use data. It hits at some core advantages. And like we said, competitors are building their own capabilities. Walmart in logistics, Microsoft and Google in cloud and AI.
The analysis also mentions that imitable business model point competitors can copy features, but maybe not the scale or the integration.
Exactly. The features might be imitable, but replicating the sheer scale and how deeply integrated everything is, that's the really hard part.
Which leads to that paradox.
Yeah.
The integration is the strength, but it's also what attracts the regulators.
Precisely. Regulators worry if dominance in one area, like retail, gives unfair advantages elsewhere, like ads or logistics. The analysis suggests Amazon's why culture is important for navigating this, for adapting.
Okay, let's pivot to the financials. The sources give us FY 2022 through 2024 figures. Revenue shows strong, consistent growth hit $638 billion in 2024, up 11%. Broad growth, including 19% for AWS, which reached $108 billion itself.
But the really striking story is net income. The analysis calls it a notable turnaround. They lost $2.7 billion in FY 2022, partly due to that Rivian investment write-down the analysis mentions.
Right, the electric vehicle company investment.
Yeah. But then profit hit $30.4 billion in 2023 and surged to $50.5 billion in 2024.
Wow, that's a massive swing back to profitability. What drove that?
Primarily, according to the sources, a huge jump in operating income. It soared 86% in 2024 to $68.6 billion. That pushed their operating margin up significantly, from 6.4% in 2023 to 10.8% in 2024.
And that came from cost-cutting and higher-margin businesses.
Exactly. Cost optimization, especially in fulfillment, and the growing weight of higher-margin AWS and advertising in the profit mix.
The balance sheet also shows assets growing, reflecting investment, but debt actually trended down in 2024.
Yeah, suggests they were paying down debt or managing it effectively. Overall, the financial picture painted is one of strength. Growing revenue and expanding margins shows operational leverage, maybe some pricing power. It fuels continued investment. The challenge, noted in the analysis, is sustaining that margin growth.
Looking at the key financial ratios table, it reinforces that recovery story. Return on equity, ROE, went from negative 1.9% in 2022 to a really strong 22.2% in 2024.
That's a dramatic improvement. Signals much better profitability and efficient use of shareholder money. The current ratio measuring short-term liquidity is stable around 1.05, 1.06. Seems low, maybe, but the analysis says that's typical for efficient retailers with super fast inventory turn and maybe a negative cash conversion cycle.
Where they get paid before they pay suppliers.
Right. And the debt-to-equity ratio dropped significantly from 0.48 down to 0.23 in 2024.
Meaning less reliance on debt.
Much less. Strengthening balance sheet, reduced financial risk, more flexibility. So yeah, summing up the ratios, the analysis shows a successful recovery, better resilience, more efficiency, gives them the financial muscle for big bets without undue stress.
So how's the market viewing all this? Let's look at valuation based on late May, early June 2025 data in the analysis.
Okay. The analysis shows a PE ratio of 32.7. Price to sales, PS, is 3.39. And enterprise value to EBITDA is 17.7.
How do we interpret those? Are they high?
Well, the sources say these are lower than Amazon's historical peaks, but still pretty significant. It shows strong market confidence. The market seems to be pricing in continued growth and, importantly, those profitability gains, especially from AWS, ads, and maybe the potential of AI.
And compared to Microsoft, Alphabet, Walmart.
The analysis compares them. The average PE for the group is 31.73, so Amazon's slightly above. Average PS is much higher at 6.74. Amazon's 3.39 is way lower. And average EBITDA is 18.80, with Amazon slightly below at 17.7.
Whoa, that PS difference is huge. Why is Amazon so much lower than the tech peers?
The sources explain it's mostly about revenue mix. Microsoft and Alphabet get most revenue from higher margin software, cloud, ads. Walmart, as a retailer, has a super low PS, like 1.14 in the table. Amazon's massive but lower margin retail base pulls its overall PS down, even though AWS and ads help lift it compared to pure retail.
So the market's likely not valuing it all the same, maybe thinking in terms of some of the parts.
That's the plausible view suggested by the sources, yeah. Likely assigning higher multiples to AWS and advertising, which props up the overall valuation despite the retail drag. The analysis calls the current valuation a balanced risk-reward profile, and it suggests if those high-margin parts keep outgrowing retail, the overall multiples like PE and EBITDA might expand over time, getting closer to tech peers, even if PS stays lower.
Okay, let's look under the hood at risks. The SWOT analysis gives a quick overview: strengths like brand, weaknesses like complexity, opportunities in new areas, threats like competition and regulation.
And the analysis points to that key strategic challenge again. Leveraging the tech and network opportunities versus managing the competition and regulation threats. It comes back to that integration being both a strength and a regulatory target, that paradox.
The sources pull out the top 3 risk factors directly from Amazon's own annual report. First one, intense competition.
Yeah, it's everywhere, across all segments. Big players, small players, new online entrants constantly popping up. The analysis says it's persistent, demanding nonstop innovation.
Second risk, expansion into new products, services, tech, regions.
This is core to their growth and invention passion, but it's risky. Things like healthcare, Kuiper, advanced AI. They might have limited experience, adoption is uncertain, tech challenges, potential liabilities, maybe they never make the money back. High execution risk.
And third, international operations risks.
As they go global, risks multiply. Economic or political instability, complex regulations on data privacy, competition law, antitrust, different legal systems, infrastructure issues, currency swings, staffing challenges, compliance. The analysis mentions specific hurdles in places like China and India.
And these risks are connected, right? Expanding globally increases international risks, and new ventures might trigger more competition or regulation.
Absolutely. And the primary mitigation strategy identified, it goes right back to those core principles. Customer obsession, invention, operational excellence, long-term thinking. The analysis suggests their unique cultural DNA is key to navigating all this.
Okay, so what's the official path forward? The growth strategy. Still anchored in the customer.
Deeply anchored in customer centricity, according to the analysis. It breaks down into pillars. First, relentless customer experience enhancement. Lower prices, they note, being the lowest priced U.S. online retailer, 8 years running better availability, faster delivery hitting record, prime speeds, more selection, content.
Second pillar, pervasive innovation and invention. AWS evolution, AI breakthroughs. The analysis mentions Trainium 2 chips, the Nova foundational model, plus Kuiper healthcare, driven by that Y culture.
Third, commitment to operational excellence. Driving cost efficiency, leveraging scale, optimizing inventory, refining the logistics network with regionalization, same-day centers.
Fourth, maximizing long-term free cash flow. That's a big focus under Jassy. Not just profit, but cash flow after investments. The analysis shows adjusted FCF improved slightly from $35.5 billion to $36.2 billion in 2024.
And fifth, strategic international expansion for diversification and new growth avenues.
And this all creates that virtuous cycle the analysis talks about. Better experience leads to more sales, enables investment, which improves the experience further.
Exactly. And that synergy is key to execution. AI from AWS used internally for retail, ads, devices. That's a powerful integrated advantage.
But the sources mention an inherent tension here, balancing huge long-term bets like Kuiper or foundational AI with market demands for steady cash flow and profit, especially now they're so big. And under Jassy.
Yeah, that's the tightrope. Jassy built AWS, defined by massive long-term investment. His appointment signaled that tech focus. But leading the whole company, retail, cloud, logistics, entertainment, hardware, all under intense scrutiny, that's a different beast than just AWS. The analysis notes that challenge.
So near term, what are analysts expecting for fiscal year 2025 based on the analysis?
The consensus forecast is about $695.3 billion in revenue. That's roughly 9.3% growth year over year, and statutory earnings per share, EPS, around $6.18.
And the analysis notes Q1 FY25 results already came in, showing $155.7 billion revenue, up 8.6%, and $1.59 EPS, which beat expectations.
Right, so the full year forecast seems credible, roughly in line with the industry per the analysis, but it does show notable deceleration from their historical growth rate, which was closer to 13%. That's just the law of large numbers kicking in. It's harder to grow as fast when you're this big. So the focus really shifts to profitable growth.
And what could make them beat those FY25 estimates?
The analysis suggests a few things, maybe even stronger AWS performance, perhaps driven by faster AI adoption, more robust growth in high-margin advertising, or better than expected cost savings and margin gains in retail. The market will be looking closely at where any earnings beat comes from, favoring the profitable units.
Okay, let's touch on some recent movers and shakers, key catalysts from the last 6 months described in the analysis. First, that big rural delivery investment announced April 2025.
Yeah, over $4 billion, 100,000 plus jobs, 200 plus locations. Like we discussed, it boosts customer experience, especially for rural Prime members, tackles a logistics weak spot, grows market share potential, and deepens that vertical integration in delivery. Strengthens the moat.
Definitely. Second catalyst, sustained AWS growth and accelerated AI integration. Ongoing, but highlighted in Q1 FY25.
Absolutely critical. Q1 showed AWS growing 17% year over year, hitting a $117 billion annualized run rate. And crucially, the analysis pointed to triple-digit growth specifically in the AI business within AWS, driven by their own Trainium 2 chips, models like Llama 3.3 on SageMaker, and the AWS backlog future committed revenue grew 20% to $189 billion. Huge visibility.
The analysis also mentioned capacity constraints holding back AWS slightly in Q1.
Yeah, fascinating detail. It suggests demand, especially for AI stuff, is so hot it's hitting their current capacity limits. Great sign for demand, but means they need to spend fast on data centers and chips, which the analysis says they are doing, front-loading CapEx in FY25 or risk losing share. It really positions AWS as a key enabler of the whole AI transition for businesses.
Third catalyst, strengthening advertising business helped by recent strategic partnerships.
Ad business keeps booming. 19% growth in Q1 FY25, hit $13.92 billion revenue, beat forecasts. The analysis mentioned partnerships with firms like InfoSum and Magnite. These help their ad tech, especially with privacy-safe data collaboration like data clean rooms, which is vital as tracking cookies fade.
And their reach is just massive, 300 million plus U.S. ad-supported audience monthly.
So yeah, this high-margin ad business is truly becoming that third pillar of profit alongside retail and AWS. Diversifies earnings, adds resilience. But the analysis notes the scale and data use here also make it a target for potential regulatory scrutiny.
Okay, briefly on people and principles. Andy Jassy, the CEO.
Deep AWS roots. Founded it, led it to dominance. His appointment obviously signaled the strategic importance of tech, cloud, innovation, but, as the analysis points out, leading the whole diverse company, B2C retail, B2B cloud, logistics, entertainment devices, all under the microscope, is a different challenge than leading AWS alone.
And ownership. Who are the big institutional players?
Main one cited is the Vanguard Group, around 7.84% as of March 2025. BlackRock and State Street also significant. So management answers to these huge, often passive, long-term investors, reflects market confidence, influences governance, and ESG provides some ownership stability.
Speaking of ESG, how does Amazon rate in the analysis?
Sustainalytics gives them a medium-risk ESG rating, score of 25.8, updated Deciti 2024, May 2025. Management of these risks is rated average.
And their rank within retail is pretty low, 403 out of 450.
Yeah, that's a key point from the analysis. Suggests they lag retail peers in managing key ESG risks. Things like logistics, carbon footprint, warehouse labor conditions, packaging waste, supply chain ethics, data privacy. Average management means their strategies aren't seen as cutting edge.
What are the implications of that low ESG rank?
The analysis suggests it could become a bigger issue for investors like Vanguard and BlackRock who factor in ESG. Could hurt brand reputation with consumers, employees. Might even increase regulatory risk if they're behind on environmental or labor standards. Proactive improvement could be a plus. failure could hinder access to capital or talent down the line. It is acknowledged internally per the annual report reference.
All right, let's wrap this up. Bringing it all together from this analysis, what's the concise bull case?
Okay, bull case in short. Continued dominance in huge growing markets, e-commerce, cloud, ads, AWS as the profit engine funding everything else, AI as a major upside catalyst both offered externally and used internally. That strong, integrated Moat brand, network, logistics, tech, customer-focused scale, improving financials, margin expansion, growing cash flow, proven innovation culture, synergistic ecosystem creating extra value, potential as a key enabler of the AI revolution.
Okay, and the concise bear case, based on the risks?
Bear case points. Intense, evolving competition everywhere. Escalating global regulatory heat, antitrust, privacy, labor, environment-threatening restrictions or fines, high execution risk on big new bets like Kuiper, advanced AI, healthcare. Growth slowing due to sheer size, potentially pressuring valuation multiples, that medium-risk ESG rating signaling underlying issues attracting negative attention. Their scale makes them a regulatory target. And the risk that the next big thing doesn't match AWS's impact, leading to slower profit growth if retail margins stay tight.
Wow. Okay, we've definitely taken a deep dive here, really guided by the sources you shared. We've hit Amazon's core businesses, the massive markets, the competition, the moat, its strengths and challenges, the financials, valuation, risks, strategy, recent catalysts, leadership, even ESG.
Yeah, the goal was really to pull out those essential insights from the analysis, give you that clear, multifaceted view of Amazon right now.
So what does this all mean for you to think about? Well, based on everything we just unpacked from this analysis, here's maybe something to chew on. Consider that inherent tension right at the heart of Amazon's model. Its incredible strength, its moat, comes directly from that massive, deeply integrated ecosystem, retail, cloud, ads, logistics, all intertwined.
Mm-hmm.
But that very power, that integration, is exactly what draws the intensifying regulatory fire that could, potentially, shake the foundations of that moat. So the question is, how effectively can Amazon really balance its relentless drive for scale and integration, that long-term vision, with the rising demands for transparency, accountability, adapting to regulators and societal pressures, all while trying to invent and scale the next AWS-sized business? That complex balancing act, that's likely going to define their path forward, something to mull over.